Hello, everyone, and welcome back to What Changes. I am your host, May, and I am absolutely thrilled to have you join me today for an incredibly crucial market update. If you are new to the channel, please make sure you hit that subscribe button, and more importantly, I want to strongly encourage you to join our exclusive Telegram channel, which is linked right down below in the YouTube description. Today, we have a massive amount of ground to cover. We are looking at silver officially hitting the $80 mark, but the actual price tag on the screen is only a tiny fraction of the overall story. The underlying data sitting beneath that $80 price point is not something you want to simply scroll past or ignore. This video is not a victory lap or a simple celebration of high prices. Rather, this is a very serious status report on a global precious metals market that is rapidly approaching a critical structural threshold. And the timeline we are looking at is incredibly specific. Let us start by looking directly at the COMEX registered silver inventories. For those who might not be intimately familiar with the terminology, registered silver refers to the specific physical metal sitting in exchange-approved vaults that is officially warrant-issued and is legitimately available for physical delivery against futures contracts. This is the actual, tangible supply that backs up the paper promises trading on the screens. Right now, that registered category has plummeted down to just 88.19 million ounces. That number is incredibly low, and more importantly, it just keeps falling day after day. Now, we have to compare that physical reality to the paper reality. When we look at the open interest for the March contract and convert those paper contracts into ounces, we are looking at roughly 240 million ounces of demand. The gap between those 88.19 million ounces of actual deliverable registered silver and the 240 million ounces of paper open interest is vast, and that gap represents the implied deficit in the market. When you take that implied deficit and divide it by the daily rate of open interest reduction, which happens through a mechanism known as the roll process, you start to get a very specific and alarming timeline. At the recent Thursday roll pace of roughly 30 million ounces per day, which was exactly the pace the market needed to maintain to avoid an immediate crisis, the mathematical timeline points to the COMEX completely exhausting its registered silver inventory around February 27th. I want you to pause and really think about that date, February 27th. You do not have to take my word for it. I highly encourage you to pull the COMEX vault reports yourself because this data is entirely public. The market participants who make it a habit to check primary sources already know this timeline is approaching. Now, before anyone takes that date and turns it into an apocalyptic, clickbait doom headline, we need to be extremely precise about what that February 27th date actually means, and equally importantly, what it does not mean. It does not mean that a catastrophic market default is guaranteed to happen next Friday. What it actually means is that the daily roll process absolutely must continue at its current aggressive pace, or alternatively, massive physical inflows of new silver need to materialize and enter the vaults for the market to successfully clear the March delivery period without experiencing severe stress. The fact that Thursday actually hit that necessary target of 30 million ounces in one day is certainly a promising sign for the exchange. However, the relief is entirely temporary. From the month of April onward, this market is scheduled to run into a massive structural shortage unless brand new physical silver enters the COMEX vaults in very meaningful quantities over the coming weeks. March is no longer the primary bottleneck keeping traders awake at night. April has rapidly become the next major pressure point, and the institutions who are paying close attention are already heavily monitoring those specific inflow numbers. Adding even more pressure to this incredibly tight situation is a highly unusual anomaly sitting right in the current data. There is a data point that changes the framing of this entire market completely. Right now, there are still roughly 200 February contracts showing incredibly sticky open interest. The holders of these specific contracts, by absolutely every indication available to us, are sitting there firmly demanding physical settlement and are waiting to receive their actual metal as fast as humanly possible. In any normally functioning, well-supplied futures market, These late-stage positions typically clear out and settle without any drama whatsoever. The undeniable fact that clearing these 200 contracts has required this immense amount of effort and time tells you something incredibly profound about the sheer underlying physical appetite beneath this paper market right now. Real buyers want real metal, and they want it immediately. This underlying physical tightness is a stark contrast to the massive wave of fear and noise that flooded social media just a few days ago. The week opened with an absolute barrage of noise and declarations from various commentators, absolutely guaranteeing that the price of silver was going to crash. The primary narrative and theory driving this fear was that because China was closed for the Lunar New Year holiday, Asian buyers would be completely offline. The assumption was that with the East out of the market, the large Western banks would have free rein to heavily short the paper markets and aggressively slam the price of silver down. And to be completely intellectually honest, there is a degree of truth to that historical concern. We know that low liquidity periods, such as major international holidays, absolutely do present a vulnerable window where concentrated paper selling can successfully move the market lower with far less resistance than usual. That is a very real market dynamic that we always have to respect as traders and investors. The Lunar New Year holiday actually runs completely through the 24th of the month, so we are technically still inside that window of vulnerability. The bearish thesis has not yet been entirely proven or disproven, but we have to look objectively at what we have actually seen so far in the price action. We opened this highly anticipated week at exactly $75.34 in the March futures contract on Monday. Fast forward to today, Friday the 20th, and we are currently sitting comfortably at the $80 mark. That massive expected slam to the downside simply has not materialized over the first 5 trading days. In fact, volatility in the silver market actually dropped down to its lowest level seen in weeks. Does that guarantee that a massive price takedown cannot possibly happen between tonight and Monday morning? No, absolutely not. The low liquidity window is still technically open. However, the loud alarm that was sounded and the absolute certainty projected by so many that this specific week would bring a devastating crash has simply not matched the strong and resilient price action we have actually witnessed through 5 full trading days. While the general market was panicking over the Lunar New Year, another massive debate was brewing regarding Hecla mining, and this story is incredibly important to examine far more closely. A claim was spreading like wildfire across the internet, stating that Hecla mining was realizing silver sales prices significantly above the current spot price because the COMEX pricing mechanism was functionally dead and broken. The narrative suggested that desperate industrial customers were being forced to pay huge, structural premiums just to access physical silver in the fourth quarter because the exchanges had failed. While that is an exciting narrative, there is a much more conventional and mathematically sound explanation that is strongly worth considering before we declare the death of the pricing system. When a major silver miner sells their raw concentrate to a large smelter, the final official price of that silver is typically not set on the day it ships. Instead, it is set 1 to 3 months after delivery through a very standard industry mechanism known as the quotational period. When you are operating in a fast-rising, bullish market, that inherent time lag actually allows a miner to get paid at much higher future prices for physical metal that was already mined and shipped earlier in the quarter. Therefore, that elevated realized price reported by Hecla could very simply reflect standard timing mechanics and the quotational period, rather than a massive structural collapse in the global price discovery mechanism. But here is the truly fascinating thing about this debate. Both of these interpretations could absolutely coexist at the same time. Perhaps there is indeed a very real element of physical tightness and premium showing up in those fourth quarter numbers, and perhaps it is also partially driven by quotational timing. The raw data alone does not definitively settle the debate right now. What ultimately matters, and what we must focus on, is that the broader supply and demand setup in the silver market is genuinely and profoundly broken. Prices are fundamentally preparing to go significantly higher on the raw supply deficits alone, but the truly sophisticated investors, the ones who diligently do their homework, always know the vital difference between what is actually confirmed by data and what is simply speculation. Mixing up facts with speculation severely weakens the real bullish argument, but completely dismissing either possibility out of hand closes the door on incredibly valuable market discussion. Now, to truly understand the global pressure cooker, we must move our attention completely over to Shanghai. In China right now, the spot price of physical silver is sitting at an astonishing $86. Even more incredibly, the Shanghai futures contracts are currently trading all the way up at $88. When you compare that to the West, the premium to acquire silver in the Eastern markets is a massive $6. Remember, China officially returns from its long Lunar New Year holiday on the 24th of the month. That massive wave of pent-up Eastern buying is about to resume and flood directly into a global market where total exchange inventories are already sitting right at extreme, decade-low levels. Furthermore, the front-month contract continues to display aggressive backwardation. For those who need a quick refresher, backwardation means that prompt, immediate physical delivery of a commodity commands a significantly higher price than future, delayed delivery. Backwardation occurring in any major commodity market is essentially the market screaming at the top of its lungs that it desperately needs physical metal right now, today, not 3 months from now. That specific backwardated pricing structure simply does not appear in markets where global supply is comfortable and abundant. It only appears when truly deliverable physical inventory is severely stressed and major industrial buyers are actively competing against each other for immediate, secure access to physical metal. The East wants the metal, and they are willing to pay massive premiums to get it. Let us zoom out from the specific precious metals markets for just a moment, because the broader macroeconomic context surrounding all of this has just dramatically shifted, creating a perfect storm. The fourth quarter gross domestic product, or GDP, just came in at an incredibly weak 1.4%. This was a massive disappointment against the broader market expectation of a much healthier 3% growth rate. When we look under the hood of that GDP number, final sales were even weaker, coming in at an abysmal 1.2%. But that is only half of the nightmare scenario. At the exact same time that economic growth is absolutely collapsing, core PCE inflation, which is the Federal Reserve's preferred measure of inflation, printed at a scorchingly hot 3%. That is its highest inflation reading since all the way back in November of 2023, and it came in completely above every single mainstream Wall Street forecast. What we are looking at here is significantly slower economic growth combined directly with stickier rising inflation. That specific dreaded economic combination is known as stagflation. Stagflation is a central banker's worst nightmare because it completely removes the Federal Reserve's traditional ability to simply cut interest rates as a relief valve to save the economy. If they cut rates to save the dying 1.4% GDP growth, they will pour gasoline on the 3% inflation fire. Historically speaking, this exact type of stagflationary environment aggressively drives massive amounts of institutional capital straight toward hard assets, like gold and silver, as all the traditional paper promises and fiat currencies begin to get severely questioned by global investors. You do not have to blindly trust my analysis on this either. I urge you to go and verify those specific PCE and GDP numbers through the official Bureau of Economic Analysis data release. Check it yourself, and you will see the exact same horrifying stagflationary picture. And then, as if the macroeconomic situation was not volatile enough, there is the rapidly deteriorating geopolitical situation in the Middle East. The United States has currently assembled its absolute largest combined military force in the region since the major 2003 Iraq invasion. We are talking about an immense deployment of firepower: 2 full aircraft carrier strike groups, 12 major warships, highly advanced fighter jets including F-35s and F-22s, and massive layers of advanced air defense systems. The global prediction market odds currently show a surging 61% probability of a direct United States military strike on Iran occurring by the deadline of March 31st. There is currently over $322 million in actual trading volume directly betting on that specific military outcome. Naturally, the global oil markets have aggressively responded to this massive build-up. When major energy prices move violently upward based on severe geopolitical risk and war fears, the broader global inflation picture directly follows suit. Higher oil means higher transportation and manufacturing costs, which feeds directly back into the core inflation metrics, which once again completely reinforces the incredibly strong case for holding tangible, hard assets like silver. This brings me perfectly to my required book recommendation for today's video, which I promised at the beginning. If you want to truly understand the incredible dynamics of what we are witnessing right now, I cannot recommend James Rickards's masterpiece, Currency Wars, highly enough. The market participants and financial analysts who have actively read James Rickards's Currency Wars understand this specific connection between military conflict and monetary policy with absolute clarity. When broader geopolitical fragmentation violently accelerates around the globe, the unseen financial warfare surrounding critical global commodities and fiat currencies intensifies simultaneously in the shadows. That brilliant book was written years ago, yet the exact strategic playbook it meticulously described is the precise one that is actively running in real time right now across the global stage. Please do yourself a favor, pick up a copy of Currency Wars and join our Telegram group so we can discuss these concepts together. The link, as always, is in the description. Returning to the data, there is one more absolutely wild data point that is entirely worth filing away in your mind. A highly unusual and massive options position has recently accumulated on the COMEX gold market. We are talking about a staggering position of over 11,000 call contracts. And what makes them crazy is the strike prices. These call options have strike prices ranging from $15,000 all the way up to $20,000 per single ounce of gold, and they are set to expire this coming December. Right now, gold is sitting comfortably around $5,028 in the Western spot markets today. For those massive options contracts to actually pay out and become profitable, the global price of gold would essentially need to roughly triple in value by December. Now, large speculative, out-of-the-money bets like this absolutely do appear periodically in the financial markets. Many of these lottery tickets simply expire completely worthless, and most of the time, they do not carry any profound informational value entirely on their own. However, what makes this specific massive options trade so absolutely worth noting today is the highly specific context in which it magically appeared and was aggressively added to the market, even as the price of gold temporarily pulled back below the $5,000 level after aggressively peaking near $5,600 back in late January. Some massive, deep-pocketed entity was actively buying the dip by placing a massive, catastrophic tail risk bet on a completely broken financial system. That is a massive data point. Let me be clear, it is not a guaranteed prediction of the future, but it is a data point that you must verify, analyze, and ultimately draw your own rational conclusions about. Someone out there is heavily betting on an absolute paradigm shift in the price of precious metals occurring before this year is over. Now, as always on this channel, we must practice strict intellectual honesty, because intellectual honesty is the only thing that actually separates legitimate signal from absolute noise. I have given you the incredibly bullish structural case, but here is the honest, objective, bearish case that we must also consider. First, it is entirely possible that Iran and the United States could suddenly reach a diplomatic deal, instantly removing that massive conflict premium and fear trade from the global oil and precious metals markets entirely. Second, that severe GDP weakness we discussed earlier could suddenly trigger a massive, broad risk-off selling event across all global asset classes, which would temporarily pull all the precious metals down right alongside the broader equity markets in a massive liquidity crunch. Third, The COMEX roll pace, successfully hitting its required 30 million ounce daily target just once, absolutely does not guarantee that it can mathematically hold that required pace completely through the remaining, highly stressful March settlement window. Furthermore, China's highly anticipated return from their holiday could end up being far more measured and slow than the bulls have eagerly anticipated. Finally, silver's massive recent move up through massive resistance levels can absolutely naturally produce a period of healthy consolidation or even a sharp technical pullback before we see any further continuation to the upside. Make absolutely no mistake. None of these potential bearish outcomes would actually invalidate the incredibly strong underlying structural thesis of physical shortages, but they are very real, immediate risks to your portfolio. The professional traders who successfully manage capital over the long term know very well that high probability and absolute certainty are not the exact same thing. What we are doing here today is engaging in financial warfare education. Proper position sizing, asset allocation, and strict risk management are entirely your personal responsibility. Now, let us transition to something specifically for the dedicated tape readers in the audience. I want to be incredibly precise here. This segment is pure tape reading education and absolutely not a financial signal to blindly buy or sell. Looking strictly at the price action, silver has officially taken out the previous Friday high from back on February 13th, which was sitting right at the crucial $79 level. That $79 level had been acting as an incredibly stubborn line of overhead resistance for some time. For the current price action to demonstrate a genuine, powerful intent for continuation higher, rather than just using this recent breakout as a deceptive distribution zone to trap retail buyers, the price absolutely should not close back down below the low of the 3:02 a.m. New York local time hourly candle that aggressively reclaimed that high. The absolute low of that specific hourly candle is the ultimate line in the sand. If the price of silver can manage to stay above that specific line, the bullish chart structure remains completely intact. Currently, when we drop down and look at the lower time frames, like the 1-hour chart, the technical structure honestly does look very good and very constructive. But that is precisely the exact reason why we absolutely need to remain calm, objective, and disciplined about exactly what comes next. The immediate, heavy overhead resistance zone is clearly mapped out between 81 and 82.25. That specific resistance zone needs to be aggressively cleared by the bulls with high volume, and absolutely without spending excessive amounts of time weakly consolidating inside of it. If the price lingers for too long inside that resistance zone, it risks grinding the upward momentum completely sideways and ultimately turning what should be a powerful bullish continuation into a bearish distribution phase. For those of you who are regular viewers of the channel and track the indicators we discuss, the 150 exponential moving average, or EMI, on the hourly chart is now sitting comfortably below the current price right around the $78 mark. This perfectly illustrates the classic technical principle, where former overhead resistance officially becomes new underlying support. That 150 EMA at $78 is now serving as the very first meaningful technical floor on any sudden market pullback. So, the technical question for the days ahead is incredibly straightforward. Does the price of silver successfully summon the strength to push aggressively through that $81 to $82.25 resistance zone and confidently continue its march toward $84 and far beyond? Or does it need to pause, retrace downwards, and peacefully digest this massive recent move first? I want to know exactly what you think. Please drop your honest read on the charts right down in the comments section below. So, let us bring all of this massive amount of data together for the final bottom line on this incredibly historic week. The COMEX registered inventory is continuing its terrifying, relentless drawdown, with the daily roll pace finally hitting its mathematically required threshold for the very first time. But that incredibly high daily target absolutely must hold completely through the final brutal days of the March settlement period. We have those highly unusual, incredibly sticky February contract holders who are aggressively demanding actual physical delivery and absolutely refusing to roll their positions forward. We have the Shanghai market sitting a massive $6 above the Western spot price, heading directly into China's aggressive return from their long holiday on the 24th. We have a deteriorating macro backdrop that just officially confirmed highly concerning stagflation adjacent conditions, with GDP growth missing its targets hard and core PCE inflation printing blazing hot above all expectations. We have geopolitical risk that now carries a highly specific, terrifying calendar date, with that 61% military strike probability sitting heavily in the prediction markets. And finally, we have the price of silver itself, which has aggressively taken out a key technical resistance level and is now sitting proudly at the $80 mark. Based on all of this overwhelming data, the open question right now is absolutely not whether the underlying long-term structural bullish thesis for silver is intact. It absolutely is. The real immediate question is simply whether the COMEX physical inflow picture miraculously improves before the April delivery period arrives, or whether this fragile paper market enters the next active contract month with the exact same terrifying, unfixable deficit math still running in the background. Your homework is simple. Pull the actual exchange vault data yourself. Diligently watch those daily registered inventory numbers. That specific metric is the only live, undeniable variable that will faithfully tell you the real underlying story long before any mainstream media headline ever does. Do not trust blindly. Rigorously verify every single piece of data that I have shown you today. The COMEX Vault reports are completely public. The critical commitment of traders positioning data is entirely public. The terrifying macroeconomic releases from the government are official, publicly available publications. The truly smart money, the market participants who actively check the primary sources for themselves, do not need me or anyone else on the internet to tell them what to think about this market. They already see the writing on the wall with complete clarity. Always remember to invest with cold, hard logic and absolutely never invest based purely on hype. Thank you so much for taking the time to watch and learn with me today. Before you leave, please make sure you hit that like button to help push this critical information out in the YouTube algorithm. Subscribe to What Changes so you never miss an update. And absolutely do not forget to click the link in the description to join our Telegram channel right now. We have an incredible community building there, and I cannot wait to see you inside. Also, seriously, go grab a copy of James Rickard's Currency Wars. It will fundamentally change how you view these global events. I am May. This is What Changes, and I will see all of you in the next deep dive. Stay safe, stay logical, and keep your eyes entirely on the raw data.